welcome back. You're watching First Trades in the Market right here on ET Now, and let's touch base with the management of Chola Investments and Finance Company. N. Srinivasan, Executive Vice Chairman and Managing Director of the business, joins in with more details on how this quarter has shaped up for them. Mr. Srinivasan, it's great to have you on the show. Thanks very much for taking out the time. Once again, it's a strong set of numbers with good PAT growth of over 53%. I mean, that's as good as it gets, or perhaps you can better that. But what are the main drivers that have been behind this stupendous rise?
Actually, this quarter had been an excellent quarter because there's been an all-round improvement. Our disbursements went up by about 3% year-on-year, assets under management by about 50%. We also improved our net interest margin, and PAT grew by about 53%. So we have also been able to improve collections and reduce the NPA. Therefore, the growth has been quite overall this quarter.
Right. Is there scope for further improvement in asset quality, particularly in home equity segment, given that you're already best in the class in the vehicle financing space?
So actually, the big improvement we expect to come vehicle finance, which is for this quarter also it is vehicle finance. As you know, the Q4 actually is one of the best quarter, normally a best quarter for the commercial vehicle industry and also for vehicle finance. Therefore, going forward in Q4, we expect to do better in the vehicle finance segment. In the home equity also, I think, the resolution is taking time. All our secured loans, we have already taken possession of several properties using SARFAESI. So the resolution is taking time. We are trying our level best to bring many of the properties to closure in March. If should that happen, that home equity also will see an improvement.
Okay. You've also clocked an AUM growth of about 20%, which is better than what the street was estimating. What have been the key segments that have done well here, and what is your current product mix like?
You see, the Q3 has been a very good for the commercial vehicles industry itself. The CV industry itself grew by about 33% across. So we have grown in all the segments. We have grown in HCV, we grow in LCV, we grow in LCV mini. We also had roughly about 20% of our disbursement in used vehicles. So the growth has been quite uniform.
And how is it that you see your AUM product mix shaping up in the next year? And will you then be changing share of home equity financing in FY18 or even diversifying into affordable housing?
Home equity is a separate segment, and home loans are a separate segment. In our home loan portfolio, we already have about close to about 800 crore worth of portfolio, which are substantially unaffordable housing. So the home equity is separate. Home equity has got close to about 10,000 crores, which are built over a period of 10 years. So both will grow independently. We have already gone on record that we will be offering the home equity product. Right now we are offering only in about 120 branches. From next year onwards, we will be increasing the presence close to about 200 branches, and so that the product can be offered to larger customers and we grow accordingly. There's a separate strategy for growing the home loan. We have already also mentioned that we are likely to set up a housing finance company, which will take place in the next financial year. Based on that, for the home loan, our strategy is reworked.
Interest margins on NIMs have remained stable on a sequential basis. Going forward, could you witness some pressures here because cost of borrowing has gone higher and also competition has also gone up?
There could be some pressure. The interest rates go up, and there could be some pressure, but it will be very marginal. The interest rates have come down over a period of time. Over the last couple of years, it has been continuously come down. We are seeing some kind of, right now, everyone knows that the interest rates have moved up, but probably it could have some kind of a marginal pressure, maybe about 0.2 that can happen. Should that happen, you have to rework your strategy. What are levers you have to offset the cost increase?
Now, return on equity has improved significantly. Is return on equity of about 20% sustainable?
So, if you see, our credit losses have coming down per month. Our cost of funds, one is cost of borrowing may go up as a percentage of assets. cost of funds as a ratio of total assets actually have been coming down. We are also working on the overall operating cost, maybe see some improvement next year. So, and also with increased volumes at a larger loan disbursement, I think overall, I think this will have an impact, positive impact on the.
Right. Do you have enough capital for growth? Any capital raising plans that you may have over the course of the next 2 years?
So at least for 1 year, I can say that there are plans, and we even for a 25% growth, our capital adequacy is quite comfortable and accruals are quite comfortable. So immediately, I don't see any. There are no plans to raise any capital.
Right. What kind of expectations do you have for the budget, particularly towards higher trust or when it comes to the rural sector, or for that matter, interest subsidies, so to speak?
There, of course, these are all guesswork. But I can say that there is likely to be a lot of spending on infrastructure, plus the insurance allocation may go up. Other than that, I have nothing specific to.
Right, Mr. Srinivasan, we leave it at that. Thanks very much for joining us with details about your earnings and how the business is shaping up, which from your numbers seems to be in a very, very strong position. That's from One More Management, Chola Investments, talking about their growth targets for the future. The market for its bit, well, sideways to sluggish, nothing to really worry about. We're still